Welcome to the BankTalk podcast, the show where we talk to leaders and experts from the community banking sector. Whether you are a current CEO or aspire to be one, this podcast will give you valuable insights and advice on how to run your financial institution better. Each episode explores a new topic with a guest who brings their unique experience and knowledge. Tune in and discover something new each time you listen.
Hello, and welcome to BankTalk. I'm Jordan Kelly, your host and consultant at Remedy Consulting. Today, we are sitting down with Elizabeth Yergubian, a government affairs consultant with over 25 years of experience working with all three branches of the federal government and former director of the NCUA board. Yergubian's extensive experience advocating on behalf of credit unions has given her a unique level of insight into the current state of the NCUA board and how regulations are affecting credit unions and community banks alike. So without further ado, let's dive into our discussion. Hello, Elizabeth, and welcome to Bank Talk. Thank you so much for joining me today.
Oh, it's my pleasure. Thank you for having me.
Absolutely. So, Elizabeth, tell me a little about, you and I started chatting already this morning, but give me a little bit about your background. Tell me a little bit about yourself.
Sure. Well, I started my career after law school working as an attorney at the Federal Reserve Board, where I concentrated on consumer financial protection regulations, worked on those regulations, writing them, interpreting them. That department that I worked at the Federal Reserve as an attorney eventually became the whole agency, the Consumer Financial Protection Bureau. It evolved into that later down the line after I was there. But I did start my years at the Federal Reserve and worked there for about 4.5 years. And after that, I wanted to go in-house and get some industry experience. So I worked in-house at Sallie Mae Student Lending Company, and I was assistant general counsel there, where I concentrated on, consumer lending, consumer loans, their private student loan products, specifically, the language in their agreements, lender agreements with consumers, also a lot of work on their marketing of student loans. And I was there for a couple of years. And then I was really interested in getting more involved in the advocacy side of financial services. So I went and worked for the Independent Community Bankers of America. And I was vice president and senior regulatory counsel there, where I, worked on the regulatory advocacy for banks, for community banks, specifically concentrating on consumer financial services issues again. And this was during the Dodd-Frank years. So I was pretty involved with that. I left the ICBA after almost 7 years and led the regulatory advocacy team at the Credit Union National Association. So I went from the independent community bankers, and then I went to the credit union side, and I led that advocacy team at CUNA. Now it's called America's Credit Unions, and was there for several years. And then I was approached to go to the NCUA and work directly for then Chairman Todd Harper as his director of the Office of External Affairs and Communications, and also his policy advisor. And that's where I was until the administration changed. And now I'm back to lobbying, regulatory and legislative advocacy, only as a partner in the firm Atlas Advocacy, which is a bipartisan advocacy firm.
Well, Elizabeth, when you and I were chatting earlier and even before we got on today, I think what excited me was that you have such a deep background on both the banking side and the credit union side, because as we well know, there are some pretty significant differences there that are, especially today, we're recording today on July 23rd, 2025, where, there's some things happening that are going to have some impact here. I think it's going to be important for us to talk about.
Absolutely.
All right. So I've got to ask you, you had an awesome title at the NCUA, Director of the Office of External Affairs and Communications and Policy Advisor to the Chair. It might be the longest title I've ever heard. Certainly a little bit of a mouthful. So tell me about the NCUA board specifically and your role there.
Sure. So the NCUA typically is a 3-member board. 2 members can be of the same political party, and 1 can be a different political party. And pretty much historically, not had really any political appointees except for the board members, their senior advisors and their executive assistants. Those are all political appointees. But then there's two or three other positions that the chairman can have at the NCUA that are political appointees. And one of them, and when I was there, Chairman Harper had two of them. And one of them was the director of the Office of External Affairs and Communications, and then the deputy director who worked with me leading the department. So we were both political appointees under Chairman Harper, and we were pretty much the only two people in the agency that were political appointees that weren't tied directly to the board, meaning we weren't, his senior advisors or executive assistant to the board members. And what I actually served in a dual capacity, because not only did I serve as director of the Office of External Affairs and Communications, I was also the chairman's policy advisor and, advising him on policy issues throughout, his tenure on everything he pretty much worked on. I would be part of those conversations for the most part. Now, the Office of External Affairs and Communications is a little unique in that we only report to the chairman. Whoever the chair is, we would report to that person, not the full board. So unlike a lot of other departments at NCUA that reports to the full board, or reports to the executive director who reports to the full board, and they're accountable to the full board. There were two offices at the time that I was there that did not do that. One was my office, and one was the Office of Minority and Women and Inclusion. But the OMWE office didn't have a political appointee as in charge of it. I was a political appointee and only answered to the chair of the NCUA. And I'll explain why that is. Typically, our department ran all communications. We did internal communications, external communications of the NCUA. We were the spokesperson. We helped the chair serve as the spokesperson for the NCUA. We also did all of the legislative affairs, congressional affairs for the agency. We ran the website. We arranged all the engagement with external stakeholders. So, the meetings with credit union leagues and credit unions and consumer groups, that went through our office. And we also did a lot of the work with the interagency councils, like the Federal Financial Institution Examination Council, the FFIC, the FSOC that the Secretary of Treasury chairs. We were involved with those interagency councils and helped the chair in his representation there as well. Because the chair, by statute, the chair of the NCUA is the spokesperson for the agency, not the board. The board votes. There's a 3-member board. They vote on things. They vote on rules, regulations, what have you. But the spokesperson for the NCUA is the chair. So that's why we reported only to the chair. I mean, we would of course be there to provide assistance here and there for the other board members, but we were specifically accountable, and reported to the chair. So that's pretty much that role. Now, in compared to the banking side, I had counterparts at the bank regulators, banking agencies, FDIC, Fed, and whatnot. They were not political appointees for the most part. They were, career government employees. So I was a little bit unique in that the role at the NCUA is a political appointee.
We'll be right back.
Is your technology spend getting a little out of hand? Are you worried about making those big strategic moves because of those hefty vendor contracts? Or maybe you just feel like your technology is currently holding you back. In today's banking world, overspending on technology is a risk you just can't take. Going up against those major vendors on your own can be tough, expensive, and especially when the contracts are designed to benefit them. That's where Remedy can come in. Remedy Consulting helps our clients stay competitive and grow their business with the right technology, products, and their spending strategies. Not a Remedy client yet? Head on over to remedyconsult.net for a free review of your tech stack, spending, and contract terms. Even if you're not the perfect fit, you'll walk away with expert advice and confidence in your technology decisions. Check us out at remedyconsult.net or give us a call at 262-955-7776. Thanks for tuning in. And now let's get back to the episode.
So can you give me the implications of that? I mean, for my own education and for our listeners, but give me a little bit of tell me what that means on a reality level to bankers and credit unions when on the banking side they are not political appointees, and on the credit union side your position was a political appointee.
Yes, and I'll caveat that too. Now, things could change under this administration because I know the Trump administration is looking to make more folks political appointees or like a Schedule C level employee. So I know there's been movement there. So the structure of all of this could always change. But when I was there in years prior, it was not. It wasn't that way. And like I said, my counterparts tended to be civil servants, at FDIC and OCC and whatnot, and at the NCUA, I was not. I mean, I don't know how that would really impact someone at the bank level. I think for purposes of working with different trade associations, you saw a different OEAC director every so often. You didn't always have the same person because the person was a political appointee. So they would often change. I would often change. And I always made that distinction when I spoke to credit unions that, look, my position is a political appointment, because I don't think that was understood in the industry. I know it wasn't understood in the industry. And I think some folks always thought the OEAC director was getting fired all the time because they weren't there for very long, and I used to make a joke about that. It was like the Defense Against the Dark Arts professor or teacher from Harry Potter. Like they were there, a different OEAC director every year. Well, it wasn't because they were, the turnover was because it's a political appointment. So there's going to be some turnover there. So I actually don't think many in the industry, even at the high levels, like even in trade associations, understood that the position was a political appointment and the deputy was a political appointment. So I always started my remarks whenever I spoke to industry, folks. I would let them know that, so they knew, look, if I'm gone in 2 years, it's not because I was fired. It's because I was fired, but it's because this is the turnover in policy. This is what makes things, work for that agency. So how it impacts them, I mean, I guess I don't know how it would directly impact anyone in the industry. I think it directly impacts the agency because it's a different reporting structure. So whereas everybody else sort of reports to the executive director up to the board, with some exceptions, my office didn't do that.
I mean, from what I've heard, and I guess I would imagine that likely how it would impact them, and going back to your comment on maybe every 2 years or something you might see a new person in that position. If that's the case, then at a credit union level, at an association level, if you're trying to get things done, make connections, kind of get to the people who can hear you out, I would imagine that having a constant changeover can make some of those things a little more challenging.
Yeah, I agree with that. And I think it was helpful that Chairman Harper, who was my boss, had the foresight to pick someone from the industry and say, "You look, I'm going to have my OEAC director be someone that came from the credit union world and knows all of these folks and knows the bank side too," because I had that background, because that could, I had a lot of those contacts coming in. And in fact, I had to actually get a waiver to have the job. It took me a long time to get the job because at the time, the Biden administration had a ban against hiring folks that at one point, lobbied the agency that they're going to work for. So I had to have a special waiver that took several months to get, to allow me, they made an exception. They made some limited exceptions, and they did make an exception for me to work for the NCUA, because typically you can't, the administration didn't want somebody going from the industry, then now they're representing, the industry in a government capacity. So it did take some hurdles. We had some red tape to get through for me to have the position. But I think the chairman at the time understood that, like, he wanted He wanted somebody that really knew the industry well and had those contacts so that there was accessibility for them in the agency. And also, as a caveat, I'm talking about political. I'm a political. This person's a political. This is financial services. I don't even know what politics. I mean, I've been in financial services working for the Fed and, industry, now working for the NCUA as a lobbyist. I don't know. I've always been the same person. There's an apolitical nature about working for financial services, I feel, that it's becoming kind of politicized. But for purposes of me, I've never really thought of it as a political job.
Interesting. Okay, so actually let's talk about a little bit about NCUA board specifically. So when you reached out to us and when we were chatting a little bit earlier, we talked about how there are changes going on at the NCUA board level. Talk to me a little bit. We talked a little bit about how somebody becomes a board member, but tell me a little bit about what has happened under the new administration.
Sure. So typically you have like a 3-member board, and the chair is usually the political party or of the president. So when I left, or towards the end of the year when President Biden was president, Chairman Harper was the chair. And then there were 2 other board members, Vice Chairman Hauptman and board member Tanya Otska, and they were the other board members. And Chairman Harper was a Democrat, Biden's a Democrat, so the chair is the same as the president. Then we have a change in administration. So now comes President Trump. The chair then switches to the Republican on the board. So then Vice Chairman Hauptman became Chairman Hauptman, and board member Otska stayed the same. And Todd Harper, who was chairman, then became board member Harper. And the unique thing about that is because it's staggered terms, board members all have like a 6-year staggering term. So you had a situation which has happened every now and then, I think once or twice in other times, where you had the chairman of the board be a Republican, the party of the president, but the 2 other board members were Democrats. So they had the majority. They don't set the chairman still sets the agenda, talks about, could control a lot of the examination aspects of what the agency does. But you got 2 board members there that could also put things on the agenda, and they have the majority in the vote. So it kind of limits the chairman a little bit because they don't always have the votes. They may or may not have the votes. So that has happened before. When I took the position working for Chairman Harper, at that time, the other 2 board members were both Republicans, but the chair was the same party as the administration, which was Democrat at that time. So that was when then I left. And because Chairman Hauptman is now chairman of the NCUA, he then chooses his OEAC director, because that's now he controls OEAC. Board member Harper no longer controls OEAC. So that's when I was replaced with someone, a person on his team, and the deputy as well. Now, the difference there is the president soon after that dismissed board member Harper and board member Otska and just wanted Chairman Hauptman to run the agency for the time being. And that they then brought a lawsuit against the president, the administration, and a decision came down yesterday at the district court level that they were incorrectly dismissed and reinstated them. So that was yesterday. So we'll see how this develops. I'm sure there's going to be appeals and whatnot. But as of now, the courts have decided that the administration could not dismiss board member Harper and board member Otska, that they had terms. Their terms were still going. They could not just dismiss them based on the reading of the statute and the legislative history that supported the statute.
Interesting.
So that's going to be developing, throughout the several months ahead.
As with everything, it's going to be a little bit ongoing. But let me ask you this. My understanding, what I just heard, is that for a number of months, I guess I don't know what that timeline has been, but it sounds to me as if the board has been operating with a single member as opposed to its typical three-person member.
That's correct.
Okay. So in that time frame where the chairman has been on board and kind of running things, what have been some of the outcomes of a 1-person versus a 3-person board?
That's a great question. So there's some folks that read the statute as allowing a one-person board to be able to do what a three-person board can do. And in terms of the duties of the board, the way I read the statute is no, you have to have a quorum of the board. The quorum of the board is 2 members, 2 out of 3. Now, there's a caveat to that. And that comes with certain duties, like the board when they're finalizing regulations, when they're voting on appeals, certain appeals that come to them, when they're going over the budget. All of that needs a board. But there's a lot of duties of the NCUA that could be done by the chair, such as something with regards to setting the examinations and call report changes, and a lot of things at the lower levels of dealing with field of membership and mergers at the lower levels are delegated down to folks at the director level. So they don't rise to the board's level unless it's appealed, unless a party appeals it. So there's a lot of things that could happen with just a chair. I mean, you could kind of go into autopilot in terms of running the agency with a chair. Where it gets tricky is if they're trying to finalize a regulation. You're going to need the full board for, and that didn't occur during those months. So there wasn't any time where they were trying to get a regulation through or finalize anything. The last few months have been mostly restructuring the agency, getting briefed on things, going through the budget, but not voting on any changes. So at that point, they could kind of operate with one chair, and then what things were happening with regards to credit unions, they could operate with that delegated authority down to the director level. Now, if he started finalizing rules and regulations by himself, that would be tricky. That would probably have some legal scrutiny. But that
Are
didn't
there
happen.
any pending regulations at this point that now, at least in this interim period, until this is all finalized, it sounded to me as if we're back to a 3-person board. Now that we've got all 3 folks back on board, at least temporarily, or at least for the moment, are there any pending regulations that are going to have to be voted on or pushed through while they've got all 3 folks?
I mean, there's a couple things, nothing major that comes to mind. I think they have something on regulation. There's a couple things that I remember that were pending, but nothing really, really major. Because typically what you'll see is when I mean, if you're in an administration and that Chairman Harper knew he was going to be losing his chairmanship in December, or I mean, after the election, he knew that. So a lot of times what you'll see is, the election happens in November, at that December board meeting, and you're kind of thinking this through anyway, even before that, you're going to finalize anything that's still pending at that December board meeting while you're chair.
Absolutely.
And then it switches over. So, I know there was one big rulemaking on succession planning that was really kind of the big one. And that was finalized in December when Chairman Todd Harper was there, because that was really his last opportunity to do that. Now it switches over to, Chairman Heltman, and then his agenda, takes over. But there wasn't a lot of pending. I mean, some couple administrative types of things, but nothing major that comes to mind. It was really that succession planning. I mean, if it was major, they were trying to get it done in December.
Makes sense. Okay, so now let me pull us back a little bit from the inner workings of the board itself. I want to talk on almost a little bit of a higher level and talk to you about, again, you've seen both sides of this. I want to pick your brain a little bit on banks versus credit unions, and particularly from a regulatory level, what does that look like? So talk to me a little bit about how different is the regulatory structure between banks and credit unions? And based on your experience, what are the most impactful differences, particularly down to the bank and credit union level?
Yeah, sure. There are a lot of differences, but I will start out by saying, all of the, financial regulators do work together to have some continuity. So you have your interagency councils, the Financial Stability Oversight Council, the FSOC, led by the Secretary of Treasury. You have the FFIEC, which is all, with the Fed, the OCC, NCUA, FDIC, others, that tries to make sure, examination procedures, there's some continuity there. So I think there's an effort by the regulators to not have them all be completely different, but that there is some level of continuity among what they do and what the NCUA does. And of course, we were active participants on those councils when I was there. Now there are some differences. Like I said, the NCUA does not have authority to regulate credit union vendors, whereas you'll see that on the bank side, they do. Bank regulators do have that authority. So there are differences like that. One main difference that I like to highlight is, on the bank side, so you have the OCC that regulates, national banks, savings associations, the big entities like your JP Morgan Chase, your huge entities. I mean, JP Morgan Chase is bigger than all credit unions combined. So it's one JP Morgan Chase is equal to everybody that the NCUA regulates. So they take over the large ones. And then you have the FDIC that, examines safety and soundness for, state charter banks, but also controls the deposit insurance fund, which is the insurance fund for all banks. So, if I go to a bank, I open up an account, it's insured. I'm a customer, I'm insured up to $250,000 in that at that bank. The FDIC, you'll see the sign, FDIC insured. That sign has to look a certain way by regulation. So I know that my funds are insured up to a certain cap. And the FDIC controls that deposit insurance fund and also examines, state chartered banks, FDIC member banks. And then you have the Fed, which also examines Fed member state charter banks, sets monetary policy, does all the stress testing for larger institutions, deals with the international banks, sets policy on interest rates for the whole country, and has a liquidity facility. The Fed discount window has a liquidity facility that all institutions, even credit unions, can access. So they all kind of do something. They all have a superpower. You know what I'm saying? Like the FDIC has the cool little deposit insurance fund. That's the big deal. That's the insurance fund for everybody. OCC has the huge mammoth banks that are like the too big to fail kind of banks. The Fed sets policy and does all the international stuff and does all the stress testing and has the liquidity resource for financial institutions. They all have their own little superpower. Well, the NCUA is kind of distinctive in that they do all of that for credit unions pretty much. They are the insurance fund for credit unions. So they, instead of the deposit insurance fund, it's the share insurance fund that they control. Same thing, up to $250,000, for a member account at a credit union. And it says NCUA insured instead of FDIC insured. They do all of the examinations for credit unions, safety and soundness, everything, no matter how big you are. They do all of the examinations themselves. The only thing they don't do is consumer protection examinations for credit unions that are over $10 billion and above. The CFPB does that, and they do it for banks too, CFPB. And they have the liquidity facility, this central liquidity facility that they also control, which is a liquidity facility for credit unions. So they're kind of doing all of that for credit unions, where you see it kind of diversified on the bank side. So that's very unique. And when I see that, and so what are the differences? One thing I noticed when I worked at the NCUA, and even I noticed this when I worked at the Fed too, I feel like the NCUA is everyone works their butt off. Like they are the hardest working people. It's a lean agency. I wish there were more people there. And even in representation with on interagency councils, we would always send like the same people. Whereas, the FDIC and the Fed would have, 10 people working on a council when we would have like one or two at the NCUA. So it's a very lean and mighty agency. I wish it wasn't as lean as it is, because I just, as a consumer, as a credit union member myself, I want that agency to be as effective as possible in protecting, me as a member. And I just wish it had more resources like the banking regulators. That's one distinction I could highlight.
Do you see a direct correlation between size and number of the banks that are regulated by all three of those different groups versus size and number of the credit unions that are regulated by the NCUA?
Yeah, I mean, obviously the banking industry has a complexity that you're not going to see at the credit union industry. Credit unions are not-for-profit financial institutions. A lot of them are very tiny. I mean, you'll have credit unions that are $100,000 in asset size. I mean, that's unheard of for a bank. I mean, you can't. I mean, a bank isn't going to be that small. So you do have, it varies. You'll have like a little church credit union that's maybe $50,000 in asset size that's run out of someone's basement, up to, Navy Federal Credit Union, 100 billion or how many billion in asset size. So there is a lot of variation there. And like I said, one JP Morgan Chase is bigger than the whole credit union industry. So there is a size and complexity issue there. But in terms of numbers of credit unions, it's about equal. I'd have to double check that, but pretty much the number of credit unions, it's, 4,200, 4,300. It goes down every year, just like it does on the bank side. But the number of going into and examining and all of that, it's not much different than than on the bank side. And you have three regulators on the bank side, plus your state regulators that do the state work. You also have state regulators on the credit union side, because if it's a state charter credit union, they're going to be looking at those credit unions as well. So financial services in general is a very, very heavily regulated industry. One of the top, your top three typically are, food and drug, financial services, nuclear, right? And you want that, for purposes of, you don't want this thing. This is people's money you're talking about. You want that heavily regulated. At least I do as a customer. And the fact that we have these different agencies kind of all having some sort of role is, I think, a good thing. I like the fact that it's diversified. If one agency controlled all of this, that would make me extremely nervous, especially if it was like run by one person and not a board or, not many people, because I think that leads to a lot of vulnerability. And the fact that it is fairly diversified is good. My only complaint, like I said, is I think the NCUA needs to be a little less of a lean agency, because there are a lot of credit unions. There's thousands of them. And credit union members are now like a third of Americans. So I think it does need to be taken more seriously than it is.
All right. So on a different topic, and kind of the last thing I want to talk to you about, but going along with, this regulation and really looking at it, how credit unions are monitored and regulated versus banks. Recent hot topic is discussion around, fact that current administration may be interested in removing tax-exempt status for credit unions, put them on more even footing with banks, maybe increase the tax rolls. Give me your thoughts on that.
Yeah, so that's always a threat. I feel like when I worked at CUNA, it was always this threat that was out there. And there's years where it becomes a little more of a threat than in other years. And I'll tell a little story. I feel like this is just my opinion, having worked in this industry for a while. I feel like when we have a Democratic administration that's putting a lot of regulations on the financial services industry, like during Dodd-Frank, which was a huge law impacting everybody, all financial institutions. I feel like during those times, the banks want to be like BFF with the credit unions, because they want to say, look, the credit, we're all lobbying together. We're all good financial institutions, and credit unions, we're all in this together, because credit unions have a credibility that's helpful when you're lobbying against a lot of regulation, because they're member owned. It's a cooperative. It's not a for-profit entity. You want them by your side. So I feel like in the time of like an Obama administration, you're not going to see the tax argument come up, because the banks aren't going to be pushing it as much, because they want their credit unions sitting next to them in those meetings. When it then switches over to the Republican side, then it's like, all right, credit unions, I'm throwing you under the bus, because we're not going to have the regulation issue anymore. And now we can attack you on the tax stuff, because we don't need you as our friend anymore. So that's what you're seeing here. Because the tax stuff, yeah, the government's looking at it, administration, but it's always pushed by the bank side. I mean, that is their piece that they like to lobby, because they feel like it will, level the playing field. And that, I mean, that's a fair position. credit unions, they are a different structure, not for profit. They have so many more limitations on what they can do in terms of, lending caps. They can't give member business loans at the same level that, banks can. They can't charge the same level of interest on things. If it's a federally chartered credit union, they're capped at, was 18% on credit cards and things. They have maturity limitations on how long the maturity of a loan could be in the Federal Credit Union Act. They're member owned, one member, one vote, Democratic. They elect their board. It's a cooperative. And then, of course, they operate within fields of membership, which has really nothing to do with their not-for-profit status. It's just that's there too. But really, the fact that they are, tax exempt has to do with the fact that they are not-for-profit financial institutions like a cooperative, not the fact that they operate within a certain field of membership. But that said, there are a lot of limitations that credit unions have in their services. Now, well, do I think they should be taxed or not? I mean, I don't think it's up to me. It's not my decision to make. What I think is kind of irrelevant. But I think if that there was ever a world where that happened, you would have to take a look at some of these other limitations that credit unions operate under, because you got to pick a lane. If it's going to be not tax exempt, then why do we have a member business lending cap? Why are we limited on the capital that we could raise? Why are we limited on investments that can be made? And I say we, speaking of that industry. So I think that has to be looked at. It's not just the tax issue. It's a whole other bunch of issues that credit unions have that are different than banks. And if you're going to make one change, you're going to have to reevaluate the whole structure.
So all right, last question for you on this one. As you said, depending on administration, depending on maybe overall economic situation, this tax exempt status versus non, it's almost a rolling issue. Comes in and out of popularity.
Yep.
How, in your opinion, and based on some of these conversations you've had up at the federal level, how likely do you think it is that something like this would get passed under this current administration?
I mean, theoretically, everything's on the table. Everything's on the table. So could something happen? Yeah, I think it could happen. Do I think I would say under a 50% chance? I mean, I think the smart thing that the credit union industry has done is they've always worked this issue, even when it wasn't an immediate threat for years. They always had an infrastructure. The credit union advocacy lobby, whatever, has always had an infrastructure in place to deal with this issue when it was popular and when it wasn't popular. And that is the key to effective lobbying. If I could tell anyone how to be a lobbyist, it would be that. It would be, don't just lobby the issue when it's hot. Lobby it when it's not hot, because then it's going to become hot and you're going to be like, what am I doing? Now I have to set up an infrastructure. If you already have an infrastructure in place that's just moving along for years and years and years and years, it's there to address it when it's hot. It's there to address it when it's not. And you have that momentum there during the entire time. And the credit union industry has been very good about that. They always have a ton of issues to work on: interchange, Dodd-Frank stuff, mortgage stuff, CFPB stuff. But they never stopped working that tax status issue, even in years when it wasn't really an issue. They always kept that infrastructure there. And, had a political action committee, or a PAC fund, had money, was talking to members, was making sure that they had certain relationships with members, were trying to get members into Congress that were credit union supporters in case that tax issue ever came up. So the fact that they were sort of thinking several moves ahead in their advocacy efforts, I think will help them in the years that this then becomes a hot year like this year. So if I were to say give my chances, I would say less than 50%, because even with that powerful infrastructure, things happen, but I think the probability of it is less because they had that infrastructure in place for years.
That's an interesting perspective. I appreciate that.
Mm-hmm. Yeah,
All right,
it's
so
the
I know
key to
we've
lobbying.
covered
Yeah, definitely the key to lobbying. That is it.
is an always on approach.
Always on.
So I know we've covered a lot today. We kind of bounced back and forth between quite a few topics. Any last thoughts for us?
I think the only last I would say is sometimes we talk about government and like an overbearing government. And I agree with that to some extent. But I think with financial services, you really want the very best. I mean, that is your money. Money is emotional, at least for me. And I'm going to want the very best people at those financial regulatory agencies, the very smartest. And I want them all working together, and I don't want them fighting. And I know politics always comes into play, but as much as you can have bipartisan collaboration and support, I think it's a good thing with regard to financial services. And that's with all the regulators. And you want a lot of decision makers, because you get the wrong one who has a lot of power that could impact everybody. So I do really like the diversified approach that the United States has. You don't see that in other countries, and I think it's really made us successful.
I appreciate that. I've got to imagine, if you're a credit union leader, if you're a bank leader listening to this now, you might be thinking that, if I put on my financial institution leader hat, I might be thinking something different. I might be thinking, less regulation, fewer
Yeah.
relief exams I got to go through. That's preferred. But I agree with you. I think that we're talking about people's money here, and
Yeah. It has to be very thoughtful, because you don't want to have an overly regulatory aggressive environment that hurts some of these smaller entities because they can't keep up. You don't want that either. You want people to be able to conduct business. So I don't want to say I'm pro regulation in all respects to them. That's absolutely not the case. But you do want the most thoughtful folks in power, and many of them, so that they take the best approach.
absolutely. Well, thank you so much for your time today, Elizabeth. I really appreciate you joining me here for this discussion.
It's been my pleasure. Thanks for inviting me.
Absolutely. You have a good one.
You too.
That's it for Bank Talk. This has been Jordan Kelly, your host. Thank you for listening. Have a good day and keep on learning.
Thank you for listening to the Bank Talk podcast, brought to you by Remedy Consulting. If you like what you hear, please rate, review, and share our work with others. Thanks again, and we'll see you next time.